Appreciate everybody's patience with this morning. I thought it would give us the benefit of being able to record the lecture, and I did not want to have any confusion about were we having class, were we not, if OU decided to cancel classes. Okay, so hopefully this is review to everyone. You've read through the chapter and kind of understand what each of these sections do. But by now you realize that the entire chapter 3 is all about this formula here on rows 11 and 12, the WACC formula. And you know these inputs from your previous finance class, that we're looking at the firm's equity and its debt so that we can calculate the proportion of those two and weight the cost of equity and the cost of debt after taxes to get a weighted average cost of capital. And so I wanted to go through this and just kind of talk about applying each of these concepts, and we'll kind of follow the chapter sections in a way that it sort of takes one input at a time and talks about that. So the first one is this market value of equity. And it almost seems deceivingly simple. It is simple. It's not deceivingly. It's just, you're thinking it can't be this simple in the book. And so as we look at the book, we talk about the taking the shares outstanding and then the share price to get the entire value of equity. That's very straightforward. It's probably worth pointing out that this is the market value of the firm's equity because we're using the market price of the shares. And in section 1, they even tell us that that's the market value of the firm's equity. But then they go on to tell us that this is the market value of the firm's debt. I think that's the words they use in section 3.1. But when you go through section 3.3, where they talk about the value of the firm's debt, it's all about book value. And so they go to the balance sheet and they look at book value, and then they calculate the debt from that. So that's not a market number, even though section 3.1 said it would be. And as we've discussed a couple times in class, and we'll see a more lengthy example on it, we can talk about gross debt, which is just adding up the short-term and the long-term debt for a given year. Or we can talk about net debt, which is taking the difference between the total debt and the total cash and marketable securities. And I just put this little practice problem on here. You can follow along later. Calculate your gross debt for each year, your net debt for each year, and then we want to take the average of the beginning of the year and the end of the year to get the average for that year. Because remember, if we're looking at balance sheet data as of the end of the year, as of December 31st, on 2010 and on 2011, then the average of those two numbers for any of these lines is kind of representative of what our typical balance probably was that year. And so, again, we're using the book value on that firm's cost of debt. Checking my chat, not hearing from anybody, no issues, so I think we're good. Keep going. I just noticed that in a problem, it's pretty likely that I would tell you, we're 40% equity, 60% debt, and you could come to the WACC equation and take a shortcut. You could just plug in 40% here or 60% here and move forward with that. So don't be surprised if you see a problem that way. The corporate tax rate, the only approach really for getting the corporate tax rate is to go to the income statement and look at income before taxes and look at the taxes. And from that, just divide the two and calculate your tax rate. And this is the example straight out of the book. The question I've been getting about the assignment, and let me pull up that assignment so I can refer to it correctly. Probably the most common question I've gotten about this assignment is, do we need to do this for 3 years, or do we need to do just once, or do we take 3 years and we average it? How do we do this? Well, when I made the assignment, I gave 4 steps that I thought would make sense to go ahead and calculate 3 values for. And then for the remaining steps, I thought it really only made sense to calculate 1. So tax rate's a good example for this. If we calculated the tax rate 3 times, and we got about 15%, and then some super high number, and then about 12 or 15% again, The book is telling us, well, something probably happened in 2014 that was, let's call it non-recurring or anomalous. And then if we wanted to make our best guess going forward at what the tax rate was going to be, then we'd probably want something in that 12 to 15% range as an estimate. And so again, the question I'm getting is, do I do 1 year or do I do 3 years? You want to do multiple years and then find out, use some judgment about what you think is representative. Because remember, the reason we're looking for tax rate is so we can find out a number that's representative going forward to go into this formula. So that was section 3.4. In section 3.5, now we're looking for the firm's cost of debt. Let's come over here. We're going to see a couple approaches to that. The first is to use the book numbers. And you may remember this example from class. So let's pretend like I, as an individual, have an income statement and a balance sheet. And during this year of 2011, I earned some interest on a savings account, and I paid some interest on a mortgage. And so I could calculate net interest earned from that. I think we do that over here. Or I'm sorry, net interest paid. And then I could calculate what my debt was. So if I came into the year, or let me say cash, if I came into the year with $99,000 in savings and left the year with $99,000 in savings, then my average cash for the year was $99,000. But if I came into the year with a mortgage balance of 95, got those backwards, didn't I? I came in with a balance of 105 and then left the year with 95, then my average debt for the year was 100. And this is what you'd be doing with your balance sheet. And my net debt is only 1,000. It's my debt minus the cash I could use to pay off that debt. Then if I go back and look at the interest that I earned on that cash, it would be the interest earned. The interest I paid on the debt is the interest paid. And then the net interest, if you will, is one minus the other. So on a net basis, I paid about $9,000 in interest. And so if I wanted to know the effective interest rate of those, I'd take the interest I earned on my cash divided by my cash balance. I copy that down to see what the average interest I paid was. It was about 10%. But if we do it the way the book tells us and do this on net debt, copy that down, I had a net interest of about $9,000 on a net debt of about $1,000. So I think in my example in class, it was 400%. But here, where you can refer to this after class, in my example, it's about 900%. And so you see that this method of using just nets can be misleading. Now the book goes on to say it's okay as long as this ratio stays the same. So if I doubled my cash and doubled my debt and kept the effective interest rate the same, then all the numbers would work out just fine, and that would be okay to use that for a cost of debt going forward. But if you think about what we're going to do with our models, it's virtually certain that our cash to debt ratio is going to change. And so if you're following along in 3.5, and I hope that some groups will talk about this here in a moment, if all you could find is that net debt, then you're kind of living in this world, and it's going to be a little bit dicey to use the number that you get from that, depending on the ratio of cash and debt. In this example, they're super close, and so it exaggerates the problem. If your ratio is weighted strongly toward debt, it won't be as big a problem. And again, on your income statement, I'd like to hear from the groups, but I expect it probably told you net debt and net interest paid. But if you're able to go through the 10K and break these out into these two lines, then as you accumulate cash in your model, you'll know what interest rate to use for it. And as you accumulate debt in your model, you'll know what interest rate to use for it. So maybe instead of me continuing to talk, this would be a good time to ask somebody from a group to jump in. Zoom is telling me they've removed the 40-minute time limit on my group meeting. So I am using the free version, and we may get cut off in 40 minutes. I got a question here. Can everybody see I assume you can see the chat log going on? I will definitely post this work after I finish, although this file is kind of designed to have most of the answers in it. Could I hear from a group on how this exercise went for you? And I'm going to take notes on who contributes here so I can reward you. So just speak up on the chat or unmute your mic and just tell me how this went for one of these groups.
Yeah, I can talk a little bit if that's all right. I know my group enjoyed kind of going through and looking at the 10K versus just kind of being assigned random, numbers or something out of a textbook. We liked kind of the real company feel to it. There was some stuff I was unsure on myself, like when we were calculating the tax rate, the income tax expense was kind of weird. Like it was mostly like it said like I only saw like gain on taxes on the income statement and wasn't really sure what to do on that. So kind of struggled calculating our firm's tax rate and trying to just look for any other problems my group came across. Oh, the cost of debt with the kind of using the bond information, we didn't know how to do that. I just wasn't familiar with how to do that, even after looking through the textbook. And
yeah, we'll get to the bonds in a second. Specific. So I appreciate your comment on taxes. You said you found gain on taxes, but you didn't find income tax paid.
Right. Yeah, I had a hard time finding that. I don't know if I just missed it or what.
By the way, is this Sam?
Yes, this is.
Okay. So what we would expect to see, and probably for the sake of time, I won't pull it up, but if you have an income statement handy that you could email me, I'll pull it up and we'll take a look. What we'd expect to see on that income statement was some income before taxes or EBIT, and then an income tax expense. Did you not see those on the income statement?
Where I was expecting to find the income tax expense, it said like gain from taxes or something. I don't know. It just wasn't really what I was expecting to see, but I can email you the 10K we were looking at.
Was that a positive number for, I assume you probably saw about 3 years on that income statement?
Yes, it was. I think it was a positive number for all 3 years.
Okay. I wonder, and you're doing Continental?
Yes.
I wonder if they're in a situation where they're actually in a negative tax situation right now. But appreciate that comment. Hopefully another group will weigh in here in a second on that. And then can you talk a little bit about, were you able to find, to calculate an interest rate on your debt alone, or were you limited to net debt?
I think we just looked at net debt.
Okay. We'll want to look through that 10K more closely and see if we can break those two out. And then I'll get back to your comment about the bonds here in a moment. So can I hear from another group? Thank you, Sam, for that.
Yes, Tom, can you hear me?
Yes, who's this?
Alex Ashkar, Team Devon.
Thanks, Alex.
When we were looking through our 10K, the items that you're referring to were labeled as earnings before income taxes and income tax benefit. And in our case, the last 3 years were all in parentheses, meaning I think they actually have been receiving a tax benefit. So not paying taxes, and they actually just had their first, let me pull up the other spreadsheet. Yeah, they finally had their first positive earnings before taxes in 2017. So the 2 previous years they had negative earnings.
Okay. In 2017, did they show still an income tax benefit, or did they show income taxes paid?
Yes, they had a benefit in 17 and a benefit in 15.
What was 16 like?
They had, what is that, 1.3 billion. Well, that was negative earnings before taxes, and then they also paid 141 million in taxes.
Okay. Did they change the name of the line item there, or was it just a negative income tax benefit?
Somewhere in the document in the 10K, we saw a little bit more information about it because they had benefit in parentheses next to the item, and then on the side you could see the different years, and some had parentheses, some didn't.
Okay. I suspect what we're seeing here is a couple of oil companies who were losing money through this time period and therefore
Right.
paying negative taxes. Can we hear from somebody else?
Yeah, I'll go. Tom, can you hear me?
Yes.
So we had Tesla, so we kind of ran into the same issue where Tesla's been operating at a net loss for the last 3 years. But in their financial disclosures, it talked about the provision for income taxes, and they only were paying like $30,000. So it gave they gave two different tax rates in their financial disclosures. One was what they actually pay, which ended up being a tax benefit in the end. And then it did state that they had a potential 21% tax rate if they had been profitable, is what they had estimated to be.
Oh, nice. Glad that you found that.
Yeah, so we just use that 21% for the rest of for any of the tax rate equation.
Outstanding. That's a great approach.
So that was kind of the only issue that we ran into, is we had to go through the financial disclosures in order to find any sort of tax rate.
Okay. And who's speaking, please, on the Tesla team?
Dylan.
Thanks, Dylan.
Yep.
Okay. Can we hear I won't make any comments yet about how negative a group we are that everybody's got a company losing money, but can we hear from another group?
Yes, Mr. Hooper, this is Pete Hamrick.
Okay, Pete, what's your company?
We had Starbucks.
Great. I know they're not losing money.
Looking at the net debt, we found obviously the cash easily, the short and current portion of long-term debt, and then the long-term debt. And the one thing that we kind of had trouble finding at first was the marketable securities. And eventually we found them pretty much in a completely different section than the income statement. It was many pages down on the 10K, but once we found that, we got our net debt all to be positive numbers, which was good, I guess. And once we kind of found all the variables, it all just fell into place, which made it a lot easier for us to just get the number accurately. And then we went back into the 10K and found it to where it matched up correctly with their numbers that they reported.
Okay, so you found what shall I say, negative net debt, so a positive net cash position.
Correct.
And then what did you find for interest paid or earned?
Let me find that real fast. So we found it. Let me look at the assignment. For the interest, we were looking more towards, for the cost of debt, we had a little trouble getting all the variables, but once we found them all, they were all within the same 0.5% as from 2016 through 2018, from 1.5% to 2.25%.
Okay.
So it was pretty clear once we kind of got all the information.
Very believable number for what you might earn on some cash. So I would think for the purposes of your model, that's a fine number to use, both in the WACC. And well, I guess in the WACC, you'll have a negative net debt. So yeah. And also then when we get to the pro forma forecasting, you can go ahead and use that same number as interest that you're making on a cash position. Now, if you choose to do something with your model that puts you in a net debt position, you want to find some way to estimate what that debt would be. And that may be a good segue to talk about the bonds here in a minute. So thanks, Starbucks team, for that. Can we just go ahead and hear from the rest of the teams on this, because this is kind of a fundamental issue.
So this is Corinne. My group did IBM, and we actually chose to take this assignment and do it individually, so everyone took a slightly different approach. Some of us did net debt, and some of us did financial debt, but with our company, they actually came out to be really, really close.
When you say financial debt, is that what I'm calling gross debt?
I think so.
Okay.
I think so, yeah.
And what was your rate?
It's around 2%, which I thought was really oddly low, but we all got numbers around 2%.
Okay, very good. Let's hear from somebody else. Yeah, so your point is a good one, Taylor. We want to average really anything on the balance sheet. We want to take the average of the beginning of the year and the end of the year, because that kind of represents the most accurate number across that year. Yeah, if you're looking at Meredith's note, they did exactly the right thing. Used income taxes paid would be the same as an income tax expense, I would think. We're looking at an income statement, so it's book tax. It may not be actual. And Meredith, if that's the distinction you're talking about, let me know. But earnings from continuing operations before income taxes is what I would also call taxable income, or income before tax. Brian says the mic's not working, had to do a bit of searching. It's pretty straightforward. Okay, so thanks for those of you who spoke up on this. That's probably enough treatment of that, unless another team wants to speak up. Okay, so moving forward, now we're trying to find the cost of equity. And from your reading, there were basically two philosophies. One philosophy was that we can use this idea of that the stock price represents all the future dividends we're ever going to get. So we could use, for example, the Gordon dividend model to calculate the present value of all the future dividends. And if we know what discount rate sets that equal to the stock price, then we know what the cost of equity is. We'll do one of those. The other approach is this CAPM method, and it's that one CAPM equation for security market line. If we can estimate our beta and our risk-free rate, then we can price the cost of equity based on the riskiness of the stock. So let's look at the first approach. Gordon model. Oh, I didn't finish the practice problem on that. Did anybody, can I hear from the groups again? Did anybody try to estimate what their future dividends would be and use the Gordon model to take the present value of them?
I estimated what the future dividends would be, but I wasn't sure if that was right, because I thought I might be looking for the cost of capital for 2018, which I had actual dividend information for.
Okay, and how did you estimate your future dividends?
I had an estimate of dividend growth. I think I calculated dividend growth over the past 5 years and then averaged that. And then I multiplied the 2018 dividends by 1 plus growth. And so that would be an estimate of the 2019 dividends, which I wasn't sure if I should be using.
Okay. Well, as far as the application of the Gordon formula, I'd have to see it, but it sounds like you did exactly the right thing. You looked at how dividends have grown over the last few years, what the current dividend is, and then the present value of all of them going forward. And that looks incredibly a lot like our exercise 4 from chapter 2, our DCF model that was also on quiz 2. You're just taking a future stream of cash flows and basically calculating that terminal value. So I would think of all the companies on our list, IBM would be the best one that could apply to. A lot of these oil companies don't pay enough dividends for this to be a valid model. Anybody who's losing money is probably not paying dividends. Like Tesla, I'm guessing, doesn't pay dividends. Starbucks might be a good approach. Did anybody else take that approach? Going once?
Professor Hooper, can you
Yes.
hear me? This is Dyson. Sorry, I couldn't get my mic to connect. We were able to find like the current share price, but for Chesapeake, the current dividend was actually a lot harder to find. We ended up having to go to like a secondary source to just find like an average dividend to use for our Gordon formula model. So we weren't really sure how accurate that would be with our cost of equity calculation, but we were able to find a very small dividend to plug into that formula.
Yeah. Were you able to come up with anything, any kind of a reasonable cost of equity that way?
I don't think it was very reasonable because the current dividend that we were able to find, which again was from a secondary source, not exactly sure how accurate it is, was like 90 cents, which I mean, I guess could be okay given their current share price at the time was $4.90. And then the dividend growth rate we actually had trouble finding as well. We just assumed that would be around 10% because through all the research we did, we weren't able to find like a good concrete growth rate to plug into that formula.
So they're probably one of the more, that company probably has one of the more volatile histories of any of our companies. Tesla being way off the charts. But if you think about the great times and the terrible times that Chesapeake's gone through, it's been really difficult for them to keep a steady dividend payout for sure.
Right.
So this model would be a very difficult one to use for them.
Okay. That makes sense because again, like I said, we were looking and there wasn't even like we couldn't even find just like a constant dividend per year that they were like paying. So
Yeah. I think Yahoo shows the dividend history on there if you look at their historical prices. But again, it's even if the dividend is relatively stable, the dividend payout ratio or the dividend as a function of their income is not going to be anywhere near stable because their income has been so all over the page.
okay.
So, yeah, so for a company like that, I wouldn't want to overwork that approach, but certainly glad you looked into that approach. Again, to Corinne's point, IBM probably a whole lot better approach for them to look at it that way. This was one of our practice problems from the chapter, which I have those solutions I'll post after this. I do want to comment that in this section, there were 3 user-defined functions that the author created. One was called a 2-stage Gordon model. And the idea there was that your dividends grow at a pretty nice clip for a while, but then revert to some long-term growth rate that lasts forever. We can do that in a spreadsheet, and one of the problems I'll post does that. So I don't want you worried about using that VBA function. If you think you can estimate dividends to grow at a higher clip for a while and then not so fast from then on, you can just do that in a spreadsheet. And then the t-intercept and the t-slope functions they talked about in the book, we're going to find those using the Linest formula here in a minute. So again, I think if we stick to native Excel, we don't have to worry about those 3. In Module 3, when we talk about VBA, we'll come back and see how those things actually worked. This is something I definitely want to get to before we run out of time, and this is beta. So I think everybody was pretty comfortable. You'd seen this CAPM formula before, where the return on equity is equal to the risk-free rate plus some beta times the excess return on the market. Hopefully you saw that in your 3303 class. If not, you're going to see a ton of it in your investments class. But all it's really saying is that if we took the returns of the market and took the returns of our stock, we probably expect that when the market's up, the stock's going to be up. But if we take a point right here where the market was up, let's call it 7.5%. because this axis is the return on the market, and this axis is the return on the stock. This point indicated that when the market was up 7.5%, our stock was up about 25%. And so if all the points lined up like that, that would say, wow, our stock really goes up a lot higher. When the market's up, our stock is up even more. And then if we drew a line through that and it came down here, we'd probably see that when the market's down, our stock is down even more. And that concept, in the example I just gave, where our stock is more volatile than the market, that's a beta greater than 1. And so when we go back to this equation and plug in a beta greater than 1, it gives us a higher cost of equity than if we'd had a beta less than 1, let's say. So let's talk about how to calculate beta, because that's probably the biggest question I've gotten all week. Let me find that file again. The way we calculate it is we download our stock price history, and I just went out to Yahoo and I downloaded Walmart as an example, and I did monthly data since 1988. And then I downloaded this S&P 500 mutual fund or index for the same time period. And then I calculated a return for each month. We can calculate a return two different ways. We can do a continuous return, which is what the book tells us to do. It's taking the natural log of current over previous share price. Or we can just calculate a return the way you guys are used to. It's just the percentage change over that period. It's the current price over the previous price minus 1. I did it both ways here to show you that you basically get the same answer. So however you calculate that return, do it for both stocks and do it for all the periods, and then make a plot. I guess this one is where I plotted the periodic monthly return against each other. And so that's how I got the return of Walmart on the y-axis and the return of the market on the x-axis. And then just like we did before, I came in here and right-clicked and said add trend line, and I chose a linear trend line. And since I don't want to add another trend line, I'm going to right-click on the one I got. So I said use a linear trend line and display the equation on the chart. And I still don't know why that box is not checked, but this is the equation for this trend line. And if we think about the equation, again, comparing the return on Walmart to the return on the market, it's y equals mx plus b. And so it's this m, this 0.651, that's the beta. It's the slope of that line that I described earlier. So in a nutshell, how we get this, we download the stock prices, we calculate the return of each for each period, we cross-plot them, we add a trend line, and we look at the slope of that trend line. If you don't want to go to the trouble to make the chart, you can use this slope function in Excel, and it just tells me, it's the same chart here. It says, what's the slope of Walmart's return versus S&P's return? It said, if I did make this chart and find that best fit line, what would the slope of that line be? And so that's another way to get beta. The 651,883 is exactly the same as what we get from the chart. Did anybody attempt that in their groups?
I did. This is Daniel, and I was able to get it. I was a little bit confused at first with notation in the book with T-slope and T-interval, just because my Excel version uses just slope and interval. But after that, I was able to obtain the data off of Yahoo and do it just fine.
Do you recall what you got?
Yeah, I have it pulled up right here. I went ahead and tested around with polynomial as well as linear functions for ours, but the polynomial, the formula I got for the polynomial was it's like 0.9. I'll just do one significant figure.
Well, before you do that, Daniel,
Oh, yeah.
I think you have to use a linear fit
Oh, do you?
to have a meaningful beta, because beta is the slope of a line theta.
Oh, okay. Well, for beta with a linear, I got it was about 0.668.
Okay. For some reason, I can't get Yahoo to come up with IBM for me here. But if you couldn't go through that process, you could go out to finance, and here we go, and it will give you a beta. But finance, somebody, Daniel, maybe you need to put it back on mute. But if you go to Yahoo Finance and it gives you a beta, it's not going to be very reliable. It's a starting place, but I think Yahoo uses some algorithms to just mine the data and back into some of these statistics, and they don't mean much. I think your 0.6 or 0.7 you said, Daniel, is a whole lot more believable to me for a beta for IBM. Because again, if we think about an IBM that's almost beta that's almost twice 1, meaning it's twice as volatile as the market, just doesn't sound like a company like IBM to me. I think your 0.6 is a whole lot closer to the truth. Did anybody else try that calculation? So Brandon asked a question about not getting any real data for Chesapeake. The only real data you need here is the historical pricing. So when I go to historical data in Yahoo, and I choose a time period and then a frequency, this is the data that I download. Now this part is important. Meredith, what was your company, by the way? Could you please chat that? This part is important to look at the adjusted close, because notice that the close price of IBM goes from 73 to 72 to 66 to 70, but they're paying dividends in the meantime. And this adjusted close accounts for those dividends. So the return on the stock is not just the change in stock price, but also the dividends that get added. So when you download the data, make sure you use adjusted close. Okay, thanks, Meredith. Yeah, that feels like a bit low for target on 0.5, but probably not out of the question. So then once we have that beta, all we really have to do is plug it into this equation. There were some questions about where to find, questions about where to find the return on the market. So we found the return on the market back here when we looked at the S&P 500. We could take our time interval of interest, calculate that return. And if I look at an average, in this case, it's a little bit less than 1% per month. I'd want to do this with annual data, and I'd probably get closer to 7 to 10% historical market return. And so that's the E, R sub M. Question was what to use for risk-free rate. It's debatable, as the book says in section 311. You can use a 3-month treasury all the way up to a 10-year treasury. I think I said somewhere in here for this class, if you just want to use a 10-year treasury, that's the most consistent. And then the tax rate is from your, that we got earlier in this conversation. And so we're just plugging in equations here in section 3.9. We can ignore 3.10 since we're running out of time. Well, I just talked about 310. The second approach in 310 would be to take those market returns and subtract off whatever the risk-free rate was in that period. And I wasn't able to find data on that. Did anyone take it that far? I don't think that was even part of your assignment. So we won't, we'll just keep that out of scope for our treatment of all this. As we will 310. As I say here, there's really not a lot of additional modeling value we're going to get out of section 310. It's just using the same equations that you've used before, and this is really more of an investments course discussion about whether you can apply that to the broader market. So guys, we've got a couple minutes left. I appreciate everyone's flexibility. I hope this was valuable for you. If I can get the recording to work and repost that, I know we definitely got a lot more participation than we normally get during class. So I see some value there. If you are driving today, please be safe on the roads. I will stick around in this chat room for any questions, but you may drop off at your convenience. Thanks. So if you're still here, I'd be happy to go over 3.9 again. Okay, let's go to 3.9. Okay, so 3.9 is taking the standard formula for just the classic CAPM model, or they call it the security market line equation for the CAPM model. And we're just plugging in some inputs so that we can calculate an output. And the classic approach is just to use this equation. And this is how we put that into Excel. So a lot of today's call was about where do these other numbers come from? And then after we get them, we plug them into this equation to calculate the cost of equity. What section 3.9 is about, the author points out that theoretically, it would be more accurate to use a tax-adjusted risk-free rate. So instead of using this formula, the author says we should use this formula. So in this section, what I'm saying is let's calculate it that way and see how different our answer is. It's a bit longer formula because every time we have risk-free rate, we're multiplying by 1 minus the tax rate, both of those places. And then I said, let's just see how much difference it even makes, and let's calculate our difference this way. So I took the new way minus the classic way, new way divided by the classic way, minus 1, and got the percent difference. And it's a very small percent difference. It's about 2%, so 9 versus 9.2. As you can tell from the conversation, we just don't have that much faith in any of these models to be that precise. But let's see if maybe some of these inputs were different if that difference gets bigger. And so I said, let's come over here and do a data table to show maybe at a higher risk-free rate or at a higher corporate tax rate, this difference gets bigger. So if I were going to complete this data table, first thing I need to do is come to this cell and tell it what the output is. And then highlight the entire section and do an Alt A W G. And for this row input, let's put these numbers into the risk-free rate. And let's put these numbers into the corporate tax rate. And then let's see how this number, which is this number, how it changes with these different combinations. And what we find, we can come back, format those as percent. What we find is that if the corporate tax rate is 0, then it doesn't matter because this goes to 1. And if the risk-free rate is 0, it doesn't matter because the larger term goes to 0. And so when they're small, it's close to that same effect. But when the risk-free rate gets large and when the corporate tax rate gets large, we see that the difference in these two methods becomes a little bit more meaningful, about 10% difference now instead of 2% in the example. Does that answer your question? Okay, so the question was about finding the return on the market. So we want to calculate the expected market return using historical market returns. And so let's go back to Yahoo and find some historical market returns. Let's look up S&P. I was having problems with this ticker this morning, so I'm going to use this ticker. And let's find 5 years of data. And let's use annual data so we get our answer. Oh, can't pull annual data here. Let's pull monthly data. And let's download that. And as I'd mentioned before, we want to use the adjusted close. So I'm going to delete these other columns. And I'd like to extract just the December data from these so that we can use annual data to get annual returns. So a trick I'm going to use, you don't have to do this for the exam. I would give you the data on the exam, but let's pull the month out of each date. And let's sort by that month. And now I have adjusted close on an annual basis. So let's copy that back into here. And let's calculate the return. I'll just take this over this -1. And then let's take the average of that. And so if we're using 5 years of data, we get an average return of about just less than 8%. Okay, so let's move on to 3.5, the second one. And this is probably the one that might have been a little bit odd to people, both conceptually and then how to do this mechanically. So if you've got access to Excel and the spreadsheet, we'll redo this work here on this, what are we having today? This is a Zoom meeting we're having today. And so what I did is I went out to a place called Wharton, WRDS, and downloaded kind of my version of what they showed in the textbook. And I think I limited it to 2017 data. And I pulled anything that Fitch had given a AAA rating. And there were columns that I can include for time to maturity. This is in years. And then yield to maturity. This is in percent, and decimal as a percent. So that'd be about 2.7% yield. And what that's saying is that Johnson & Johnson issued some bonds. They're about, and forgive me if I'm a little bit wrong on this, but my interpretation is Johnson & Johnson issued some bonds that are rated quite highly, Johnson being a fairly stable company. They're almost 7 years to maturity on these particular bonds. And notice we're looking at about a dozen bonds from Johnson & Johnson, and then we look at several bonds from ExxonMobil and so on. And we can look at the time to maturity on those bonds and what their yield is. And if we plot that across, let's see, looks like I had almost 400 different bonds that we looked at from probably 100 or so different companies or 50 different companies. And if we compare, look for a relationship between the time to maturity and the yield, what we find is some contango in that curve. So there's, the longer it is to maturity on these bonds, then the higher their yield is. And so what that means is if we were going to issue some debt as a company and we wanted to do a really short-term bond, we probably wouldn't have as expensive, it wouldn't be as expensive to raise that money as if we wanted to issue a long-term bond. And so let's go through the the exercise in the book here. And this probably would make a pretty good exam question. If somebody will remind me, I'll do a video on this, especially if our recording doesn't work well.
Tom, can you repeat where you got this bond data?
I got it from, there's a source that I think you have access to as a student, and it's Wharton, WRDS. I think I was told it takes you about 5 days to activate an account.
Okay, thanks.
And I don't recommend that you do that for this class. I recommend that you use this data set. I think it's probably not the best time spent. I think you'll have a whole boatload of classes in your finance degree where you do this kind of stuff. And if you want to run with this data set, feel free. I'm looking forward to seeing people's submission to find out if they were able to find the data elsewhere. The book suggested you could find it in Yahoo, but I think most of us confirmed no, Yahoo doesn't provide this data anymore. I sure hope somebody could prove me wrong on that.
I found it on some obscure site. I didn't get as much data as this nearly, though.
Okay. I actually started with about 200,000 different bonds, and I filtered out the ones that were not rated at all. I filtered out the ones that had too short or too long time to maturity. I filtered out the ones whose yields were negative or over 20%. And eventually I worked it down to this data set. Again, this is a modeling class. I'm less concerned about you finding this data set than I am you using the data set. So what I'd like you to be able to do is take these two columns and make this plot. And so let's click here and do a control shift down and then shift right. And so now we've selected the data that we want to chart. And if I created the chart right now, it would put it down here on about row 370. I don't want to do that, so I'm going to come back up to the top. And I'm going to do an Alt-N to insert something, and then I'm going to hit D to choose a scatter plot. And really, I think this is the only kind of chart we've made in this course so far. After exam one, we'll do some other kinds. So we'll choose this scatter plot right here. And since our columns were in this order, it went ahead and put yield on the y-axis and time to maturity on the x-axis. I'll use this little trick you guys taught me with the plus sign to add some titles. And we can call one of them yield and one of them time to maturity. And again, this process we're going through now is something you'd want to be able to do on the exam. And so the question is, how can we make sense out of this glob of data? And we'll just follow the book's approach. We're going to right click on one of these points. We're going to add a trend line. And we can fit any kind of trend line. I could fit a straight line through there. I could try to do an exponential fit, which this data doesn't lend itself to because exponentials concave up. I could do a logarithmic fit, which lends itself to this data. This data lends itself a lot better. I could do a power fit, which isn't much different. The book suggests a polynomial fit. I was going to be safe with a polynomial fit. One thing I don't like about it is it shows kind of a maximum yield, and then it starts coming back down with time to maturity. Again, save that conversation for your investments class, but I'm a little uncomfortable with that. But this is what the book did, so let's do that. Polynomial will allow you to do, right now we're looking at a quadratic. We've got a second order polynomial. If I put the equation on the chart, then our fit line looks like this. It's going to be a times x squared plus b times x plus c. If we came back to that trend line and said we want a third order polynomial, now we have an x cubed term in there. And all it's doing is it's giving us the equation that we could use to fit. So if we wanted a 10-year bond, and we wanted to use this equation to estimate what the yield would be based on this data set, then this equation should calculate just a little bit below 3% yield. Any questions on that? Let's see if we can use that equation to calculate the 3% yield for a 10-year bond. So that's what I've done over here to make these orange dots, just to see how well my equation fits the trend line. So let's do that right here. Let's type maturity and yield. And so if I want a 10-year bond, then I know from my trend line it's going to be a little bit less than 3%. So I could type in these numbers. Sometimes I have luck copying and pasting, and sometimes I don't. Let's see if I'm going to have any luck today. No, I'm not having any luck today. Since that's the same number, instead of making you wait for me to type that in, I'm going to copy the formula over here from over here. So if I typed in this to calculate the yield from the bond, if I typed in 0.000003, which is what 3 times 10 to the minus 7th is, and then 0.00005, you can guess I probably wouldn't get the right answer. Let's do it that way. And my point here is that right here I'm only showing one significant figure, okay? I'm showing 3 times 10 to the minus 7th, which is this, and 5 times 10 to the minus 5, which is this, and then 21. So I'm leaving off some significant figures the way we've shown this. If I typed it in that way, I get 0.00395. So that tells me I'd be up here around 4%. Let me make those percentages. You can look at this file if you're having a hard time following me afterward. Maybe it's not as far off as I thought if I actually point that formula. Yeah, 2.97 versus 2.94. My point is I'm losing a lot of significant figures up here. When we put that chart, put that equation on the chart, we'd like to see more than just 3. So instead of 0.003, we'd like to see the 277. And the way we do that is we come back to this and give it a number. We're going to format that number to get some decimal places. And so let me get about 9 decimal places on there. And now you can see I have a whole lot more precise equation that I could come down here and type into the cell. If you have some questions on that, I don't feel like I covered that well at all, please ask on the chat or on the microphone, and I'll probably redo this part of the video to make it a little bit more clear. But if we get our equation in there the way we like it, and I like this one better because it shows more significant figures in our curve fit, then we can do this from 0, 5, 10, out to 30, and then just copy that formula and paste it. And so what I want to know is, did this formula that we just typed in, that we got from our curve fit, did it do a very good job of fitting this trend? And so we're applying this formula to all these different maturities in increments of 5. So let's copy that data with Control-C, click on the chart, and then I'll do a paste special. I'll do an Alt-H, V for paste special, and S. And it lets me add this data to my existing chart. I want to add a new series, which is in columns. The series name is not in the first row, but the category X's are in the first column. So I'll click that. And so I get these orange dots again, and you see they fall right on that trend line that we got by adding a trend line. And so we have some good faith in our ability to come over here and column in and calculate a yield based on maturity. If I had not seen all these significant figures, my orange dots might be a little bit off, and I might try to work out an example for y'all to do this week to show where that would be the case. So again, back to the original purpose of doing this, we went out and we looked at hundreds of bonds. we said the further out their maturity, the higher the cost of that debt. If we think we're going to issue a bond with 10-year maturity, then we can estimate what our cost of debt would be. And again, this is all based on our company having a similar rating as having a AAA rating. Had we done this for C-rated bonds, I suspect the yields would have been a lot higher. So questions on that? Was anybody able to attempt that?
Professor Hooper,
Yes.
this is Daniel speaking. Is there any way to, or is there any formula in order to get a polynomic formula such as that without doing it through the chart way?
Daniel, I don't believe there is. No, that's not true. I think it's probably the line est formula. And we're going to look at line est for just a linear.
Right.
I can't remember if line est does multiple linear regression or if it does polynomials. I think we're a bit off topic here, but I think the way I've done that in the past is I've set up a model and used solver to solve for the coefficients.
Oh, okay. Yeah, and I can look into that in further study. I was just wondering. So.
Yeah, if you find something, let me know.
Okay, sounds good. Thank you.
Okay, so for your purposes, I don't think this is going to be a super good use of or a super good source of the cost of debt for your company. I think the specific what you get off of the balance sheet and the income statement is going to be better. But this is an example I'd like you to include in your report after exam 1 when we go through and do the actual projects. So any other questions on this before we leave 3.5? Okay.
Hey, Professor Hooper, this is Ben Carlson.
Yes, Ben.
I'm getting a different equation whenever I add an equation on the chart. Do you mind going over that one more time?
Would you mind sharing your screen?
I actually am on like a different laptop.
Okay, no worries. Yeah, I'd be happy to go over that.
Basically, like, I think I need to add a few, I guess, what would it be, decimal places. I'm getting like a negative 4e.
Oh, you're getting a different equation. Is your chart looking the same?
Yes.
Okay. Does your fit, well, let's see what fit I ended up using on my trend line. Are you using a polynomial 3?
Okay, I think that's the problem because I'm using order 2.
Okay, that's the problem.
Okay, thank you.
I don't think the third order polynomial gives us much better fit. Let's see. With a third order polynomial, I'm getting an R squared about 0.893. If I were to go back and change that to a second order, it's about 0.89288. So I'm with you, Ben. I would use the second order, which I'm not sure why I went to the third. You get just as good a fit with a whole lot less work.
Okay.
But that's probably a difference. Okay, let's move on to 3.6.
Professor Hooper.
Yes.
This is Kylie. I don't have a question, but I think there's a few people that are asking some in the chat.
Oh, okay. Thanks. Thank you, Kylie. So yeah, let me do these a little bit out of order. What I would like to do on the exam is basically exactly what we did here. I would provide this data, and then I would ask you to estimate the cost of a 10-year cost of debt for a 10-year treasury. Okay, and the way you'd have to do that is make the chart, add the trend line, get an equation, and I'd probably tell you what kind of, so Ben and I just had a discussion about second or third order. Probably tell you what trend line option to choose. And then you take that equation to calculate your yield. So it's going to give you an equation of some form where y equals some function of x. X is going to be the maturity, and then you're going to calculate y, which is the yield on your debt. So Madison, does that answer that question? Feel like we need a lot more practice going through those steps. So I'll make a note to provide practice problems for this. For the sake of time, let me keep moving. And again, I'll put out practice problems for that. If I get a ton of questions on it, then I'll reconsider putting something like that on the exam.
Professor Hooper?
Yes.
Okay, so I was just looking back through the, let me make sure I have the right sheet pulled up here. 3.5-2. Could you go back over what you do with the, when you type in the maturity 0 through 30 and then get the yield, how that correlates to the graph?
Yeah, so I was trying to, so if we're going to use this formula to calculate a number, to calculate a yield for, I was using 10 as an example. If we want to issue some 10-year bonds and we want to estimate what the yield on them is going to be using this formula, first I want to get some confidence that I've put that formula in correctly. And so what I did is I put the formula in, and then I used it, I applied it to these different maturities and created these orange dots on the chart just to make sure that they kind of line up with that trend line.
Okay.
Because I've had some, so let's come over here and try that, but instead of the 277, let's use the 3 that we would have seen if we didn't show all those extra significant figures. And let's use the 5 and the 2 and the 1. So I'd have been a little bit off if I had used these. And so let me change where this graph is looking. If I can get to it. If I'd used that without the significant figures, you'd see that my orange dots didn't line up with my trend line.
Right.
And so I wouldn't have much faith in this model over here. And the reason I shouldn't have faith in it is, again, because we didn't use all those significant figures. But if I did use them and saw that those orange dots fell right on the line, then I'd have more faith in it.
Okay. And then in your columns, I think it's I and J. Now, what did you use? What do those correlate to? Sorry, I missed when you
It was
were
the same
over.
thing. I recreated I and J over here. So I and J were for the first graph that was in the original file.
Okay.
I just redid that work for you in real time.
Just a simpler format to get on the trend line. Okay, that makes sense.
Yeah,
That's what I was confused. I didn't know if both of those tables that you made were on that chart, or if you had just correlated that chart you made while you were talking.
Yes, I guess I could have put these down here by the graph we made on the call.
Okay.
And then left these up here by the graph that was in the original file.
Okay, that makes sense. And then I just had one more question. Let me go back to, so when we were doing the equity value for Chesapeake, on their 10K, it pulled up different numbers of like their shares outstanding. Like there were like, I think 3 different numbers like on one single line of their 10K that showed like there's 20 million, but then there's 5 million here and 7 million here. What would you suggest like using as their
Was it
shares?
an issue of basic versus diluted?
I remember seeing basic versus diluted, but I think that's when we were looking for dividend stuff, and it would just give it. It said that they were paying the same dividend within their 10K, and it didn't really seem at the time we were looking at it like it was relating to what we needed.
Yeah.
But
It could have had to do with preferred shares.
okay. So would you have to add those together, or how does that?
I'd have to see the example. The way you treat preferred shares is actually a third term in this equation. So here we're taking the portion that's equity and the portion that's debt.
Mm-hmm.
And technically, if you have preferred stock, there'd be a third term out here that would be the portion that's preferred stock. And it would have a cost of capital that's different than the cost of debt and different than your cost of equity. It would be your cost of preferred stock.
Okay. That makes sense. Let's see. I think there's a question on the chat still. I don't think he has a mic.
Yeah. I'm going to go over the 3.9, but I was also going to answer that question on chapter 3 here, but I want to make sure the answer I give is correct. I think the answer is going to be up through 3.9.
Up to 3 for the exam?
So we'll need 310. Yeah.
Okay.
So you'll need 310.1. We won't do that. I think it's going to be best if I just post a file saying exactly what will be out of chapter 3.
Yeah, that'd be really helpful for sure. Because like the first couple, like 3.1 through 3.4, are like, takes like 5 or 10 seconds to do each. But then I think as it gets more and more challenging, I'm sure people will want to know like what exactly they need to like be studying today and tomorrow.
Yeah. Yeah, and I realize that there's not a lot of study time left, so I'm not going to push it on that. But you have had a lot of time to spend on this work, and I want that to be rewarded.
Right.
I was overall pretty impressed with a lot of the answers. People obviously spent some time, and I'm looking forward to looking at the work they submitted as well.
Yeah, we were able. I mean, with Chesapeake data, I didn't know that we needed to pull that bond data off Yahoo. So we spent a lot of time like trying to work through and figure that data out, which is we figured out like impossible.
You mean just Chesapeake's bond data?
Yeah.
Okay. That's not a bad approach. I mean, a pretty good representation, even though the book says the opposite. I think a pretty good representation of what they can issue bonds for is what they have issued bonds for, right?
Right.
And so granted, their world is changing a lot day by day, but that's not a bad place to start. And the theme, I didn't really conclude it well here, but the theme on all this stuff is there's no one right way to get WAC. And
right.
You need to look at a lot of these different approaches with some judgment.
Well, and that was the whole thing when we were working through it. And like, if we were confused at like several different times, like trying to figure out exactly what numbers we needed. But then we would always come to the conclusion that it's judgment based. So like if we think it's like this income tax expense or whatever, then that maybe that's what we should use, because if we're calculating the WAC and we think that's what we should use, then that's what needs to be used.
Absolutely. Yeah. You can almost get a little bit cynical that we're making a lot of guesses at input so we can calculate WAC. Why don't we just guess WAC?
Right.
But I think there's a lot of learning in looking at the different approaches. And like I say, when you get to the job, if you're the guy with the finance degree, they're going to look at you and ask you for an intelligent answer about WAC.
Mm-hmm. Okay. All right. Well, thank you for answering those questions.
You bet. I hope that this session worked well for everybody. I was nervous about changing up the format before the exam, but I thought, well, the last thing I want to do is have to cancel class and not be in contact with you guys before the exam.
Right. I mean, it worked well for me. I'm sure some people had some technical problems with it, but I was able to hear you the whole time and at least kind of watch what you were doing on the Excel sheet, which is always helpful. So,
well, very good. Hopefully I can get the recording up for people to review.
Yeah, that'd be great.
Okay. Holler if I can do anything else.
All right. Sounds good. Have a good day.
You too. Thanks.